CAPM, is arguably the most famous equation in finance. While the math is elegant, its true power lies in its intuition. It tells us exactly how much extra return an investor should demand for taking on the risk of the stock market. To understand CAPM intuitively, we have to look at it from two directions: from the beginning, how we build it, and from the back, how it's used to value real-world companies. 1. The beginning, building the intuition. The CAPM starts with a simple question: what is the fair price of risk? To answer this, we look at three building blocks. Block 1, the safe baseline, R_F. Imagine you have $1,000. If you put it in a government bond, like a US Treasury bill, you are virtually certain to get it back with a small amount of interest. This is the risk-free rate, R_F. It represents the time value of money, getting paid just for waiting, without taking any risk. Block 2, the market reward, R_M, R_F. Now, imagine instead of a safe bond, you buy a piece of every company in the economy, the market portfolio. This is much riskier, so you expect a higher return. The difference between what the market pays and what the safe bond pays is the market risk premium. It's the price of admission for the stock market. Block 3. The sensitivity factor, beta. Not all stocks react to the market the same way. High beta, beta greater than 1, like a tech startup. When the market goes up 10%, this stock might jump 20%. When the market falls, it crashes harder. Low beta, beta less than 1, like a utility company, electricity, water. People need power regardless of the economy. If the market drops 10%, this stock might only drop 2%. 2. The CAPM formula. Putting these blocks together gives us the expected return for any asset, R_I. In plain English, your expected return equals payment for waiting, plus riskiness of the stock, times payment for taking market risk. 3. Working from the back, real-world examples. In practice, financial analysts often use CAPM backward to see if a stock is a good deal or to set a hurdle rate for a new project. Example A. The tech giant, high risk, risk-free rate, R_F, 3%. Market return, R_M, 10%. Beta, 1.5, aggressive, the calculation. Intuition. Because this stock is 50% more volatile than the market, you shouldn't buy it unless you expect to make at least 13.5%. If your analysis says it will only return 11%, CAPM tells you it's overvalued for the risk you are taking. Example B. The supermarket, low risk, beta, 0.7, defensive, using the same rates. Intuition. Even though 7.9% is lower than the market's 10%, it might be a great investment because it's much safer. You are accepting a lower risk premium because the stock won't crash as hard during a recession. 4. Key outcomes and insights. Only systematic risk matters. CAPM assumes you are smart enough to diversify. Therefore, the market won't pay you for company-specific risks, like a factory fire. It only pays you for market-wide risks, like a recession. The hurdle rate. Companies use CAPM to decide on new projects. If a new factory has a beta of 1.2 and CAPM says the required return is 11%, the factory must generate more than 11% profit, or the company is actually destroying shareholder value by building it. Alpha. This is the holy grail of investing. If a stock returns more than what the CAPM predicts, it has positive alpha, meaning the manager beat the market's risk-adjusted expectations. Would you like to see how we mathematically derive the beta coefficient using the covariance of returns?